If you're a small business owner or work for one, you've probably been hearing a lot about something called the One Big Beautiful Bill, or HR1 as it's officially known. This massive piece of legislation was signed into law on July 4th, 2025, and it's packed with changes that could significantly impact your business and your employees. Now, I know what you're thinking, great, another complicated tax law to figure out, but here's the thing. This bill contains some really good news for small businesses and working families. Not everything takes effect right away, and we're still all learning about the finer details. So today, I want to walk you through the key provisions that are most likely to affect you, your business, and your team. We'll talk about what's changing, when it's changing, and what you need to know moving forward. Hey everyone, I'm Noel Lorenzana, a registered CPA and one of OnPay's expert contributors. Before we dive in, just remember, tax law is constantly evolving and this bill is no exception. What we know today might be clarified or updated as the IRS releases more guidance. So just keep that in mind and definitely stay in touch with your tax professional as we navigate these changes together. Now let's get started. Let's start with some changes that your employees are probably already asking you about because these directly affect their paychecks and tax situations. First up, there's this new provision about tips that you've probably already heard about. If you have employees who receive tips, think restaurants, salons, delivery drivers, they can now take an above-the-line deduction for their tip income. They can deduct the reported tips up to $25,000, and this would be claimed on their personal tax return. Now, here's the important part. This only applies to tips that are properly reported and show up on their W-2. We're not talking about unreported cash tips here. And just to be clear, they still owe Social Security and Medicare taxes on those tips, which means you, as the employer, still need to pay your share too. But here's why this matters for your employees. Because it's an above-the-line deduction, it lowers their adjusted gross income, or AGI, and that can help them qualify for loans, other tax benefits, or income-based programs. Here's another one your employees will likely appreciate. From 2025 through 2028, if someone works a lot of overtime hours, they can deduct a portion of that overtime pay. We're talking up to $12,500 for single filers or up to $25,000 for married couples filing jointly. This is particularly helpful for employees in industries where overtime is common, manufacturing, healthcare, and of course retail during busy seasons. It's not permanent like some of the other provisions, but it's a nice relief for the next few years. If you have employees who consistently put in overtime, this could be a real benefit for them, and it's worth mentioning when you're explaining how the new law affects your team. Now let's talk about some changes that will make your life as a business owner a bit easier, especially when it comes to paperwork and administrative tasks. If you've ever paid a contractor or a freelancer more than $600 a year, you know you have to send them a Form 1099 NEC at tax time. Well, starting in 2026, that threshold jumps from $600 all the way to $2,000. And it'll be adjusted for inflation starting in 2027. Let me put this in perspective. That $600 threshold has been around a while, literally since the 1950s, and many felt it was long overdue for an update. This change means fewer 1099s for you to track, prepare, and send out. That's less administrative work, fewer potential penalties for missed forms, and just generally fewer headaches. Keep in mind that income is still taxable for your contractors, whom you paid, even if you don't have to send a 1099. But from a paperwork standpoint, this is a huge win for small businesses. Here's some stability in an otherwise changing landscape. The individual tax rates from the Tax Cuts and Jobs Act are now permanent. They were set to expire in 2025, which would have meant higher tax rates for most people. Instead, the current lower rates and the doubled standard deduction are here to stay. This affects your employees' take-home pay and your own personal taxes if you're a sole proprietor or pass-through entity owner. It's one less thing to worry about changing in the near future. If you or your employees live in high tax states, this one's big. The state and local tax deduction, or SALT, was previously capped at $10,000. Now it's increased to $40,000, but only for taxpayers with income below $500,000. This runs from 2025 through 2028, and it could be a meaningful deduction boost if you itemize your deductions and live in a state with high taxes, such as California, New York, or New Jersey. Now we get to the part that could really impact your business decisions. The provisions designed to encourage business investment and growth. 100% bonus depreciation is back. This is huge for businesses looking to invest in equipment, technology, or other assets. You can now fully deduct the cost of qualifying purchases in the year you make them. We're talking about things like commercial vehicles, computers and office technology, equipment, tools, and machinery, office furniture, and certain building improvements. So if you buy, say, $20,000 worth of new equipment, maybe some upgraded computers for your team or new machinery for your shop, you can deduct the full amount in year one instead of spreading it out over 5 to 7 years. So this could be a great time to think about those business investments you've been putting off. Need new software, better equipment, new standing desks for the team. The tax benefits make it more attractive to invest now rather than later. The qualified business income deduction, also known as Section 199A, is staying put and it's more accessible than ever. If you're a sole proprietor, partner in a partnership, or S Corp owner, you can potentially deduct up to 20% of your business income. This means if your business earns $150,000, you might only pay taxes on $120,000. Even if you have a side business earning $30,000, this deduction can still help you keep more of what you make. Here's one that might surprise you. Research and development expenses can now be deducted more quickly and in some cases, retroactively. If your business has gross receipts of $31 million or less, you can retroactively expense R&D costs going back to January 1st, 2022. For larger businesses, domestic R&D expenses from late 2021 through early 2025 can now be deducted over 1 or 2 years instead of 5. Now you might be thinking, I don't do research and development, but R&D is broader than you think. It might include testing new product designs, developing internal use software, or engineering solutions to technical problems. If you've been building or experimenting, your business might qualify for bigger deductions. If you offer paid family or medical leave, whether your state requires it or you choose to provide it, there's a tax credit that's now permanent and easier to qualify for. The employment requirement dropped from a year to 6 months, so more workers qualify. State or local paid leave mandates now count towards meeting the new eligibility rules. And you can now claim the credit for premiums paid on qualifying leave insurance policies, not just direct payments. Even if paid leave isn't required where you are, if you offer it as a benefit, this credit makes it more affordable to maintain. There are new improvements to health savings accounts and dependent care FSAs that could save both you and your employees real money. Here's the short version. More people can now qualify for HSAs, including those with bronze or catastrophic health plans purchased on the exchange. Direct primary care arrangements and telehealth visits remain HSA eligible. And for parents or caregivers, dependent care FSA limits are finally going up for the first time in decades, from $5,000 to $7,500. If you'd like a full breakdown of how these new benefits work and how to actually use them, let me know in the comments and I can cover it in a follow-up video. Let's wrap up with some provisions that affect families, which means they might affect your employees and possibly you personally. The child tax credit has been made permanent with the base amount increased to $2,200 per qualifying child, up from $2,000, and it's adjusted annually for inflation starting in tax year 2025, though it phases out at higher income levels. For married couples filing jointly, the phase-out begins at $400,000. For other filers, it starts at $200,000. This is a long-term win for working families, especially those with young children and middle-class incomes. If you have employees with families, this permanent credit provides them with more financial stability and predictability for their long-term planning. So where does this leave you as a small business owner? Here's what you might want to focus on. First, if you've been considering equipment purchases or business investments, now might be the time to move forward. The 100% bonus depreciation makes it more attractive to invest in your business this year. Second, review your contractor relationships. With the 1099 threshold increasing to $2,000 in 2026, you'll have less paperwork to manage, but you should still keep good records. Third, if you employ people who receive tips or work significant overtime, make sure they know about these new deductions. It's a nice benefit you can highlight when talking to your team. Finally, the permanent tax credit makes offering paid family leave more financially feasible. Look, this is a lot to digest, and we're all still learning about the implications as more guidance comes out. What we know today might be clarified or updated as the IRS releases more information. My advice: stay informed, keep good records, and work with your tax professional to make sure you're taking advantage of the provisions that make sense for your business. Also, keep an eye on OnPay's YouTube channel and website as they continue to update with new insights and reactions from tax professionals who work with small businesses every day. This legislation represents some significant opportunities for small businesses and working families. The key is understanding how these changes apply to your specific situation and making informed decisions accordingly. Thanks for watching, and remember, when it comes to taxes, it's always better to be proactive than reactive. Be sure to hit the button to subscribe, stay informed, stay prepared, and don't hesitate to reach out to tax professionals when you need guidance. Take care, and we'll see you in the next one.